There is a fascinating phenomenon that occurs when you observe traders who consistently extract money from the markets. These are not the individuals who got lucky once, nor those who struck gold only to lose it all. These are the practitioners who month after month and year after year steadily generate profit. When you study them closely, you realize that their behavior contradicts almost everything you once believed about what a successful trader looks like. They aren't exhilarated when they win. They don't rush into trades when the market is soaring. There are days when they sit before their screens for hours and take no action at all. Sometimes they talk to themselves as if debating an invisible opponent. There are moments when they eye a clear opportunity, shake their heads, and simply walk away. To an outsider, they seem strange, indecisive, or prone to missing out. But that strangeness is exactly why their accounts flourish while others bleed towards zero. This video isn't a list of tips or a technical masterclass. It is a deep dive into the authentic psychology of consistently profitable traders, into habits that look peculiar from the outside but serve as the foundation for every correct decision they make. As you listen, you may realize you have done some of these things without knowing why, or perhaps you tried to stop doing them because others labeled them as weaknesses. Don't rush to the next video. Stay here. Part 1. The Internal Dialogue. Have you ever seen a trader whispering to their screen? If the price retraces here, I'm in. If not, I sit out. My stop loss goes here because... and if it breaks this level, the thesis is dead. Professional traders do this daily. It isn't because they are unstable. It's because they've grasped something most never will. The market does not care about your feelings. It only reacts to actions. The problem for most isn't a lack of technical skill. It's the dark gap between seeing a signal and clicking the button. That gap is where emotions slip in and sabotage everything. In psychology, this self-talk is known as verbal reasoning. By converting vague feelings into specific language, the brain is forced to organize information logically. While an amateur feels an opportunity, a professional states it. I am entering because conditions A, B, and C have aligned. If D happens, I exit. I accept risk X. This is just one of 30 trades this month. This transforms trading from an emotional gamble into a structured process. The trader's brain is a delicate instrument. The same data processed in a high-stress state, fueled by cortisol and adrenaline, produces a vastly different decision than when processed in a state of calm. These hormones directly impair your ability to read charts and calculate risk. Self-talk is a tool to slow down the decision-making process, forcing the brain to switch from the emotional system to the rational one. If you talk to yourself, don't be ashamed. It might be the only reason your account hasn't blown up yet. Part 2. Productive Overthinking. There is a common myth that a great trader is a person of lightning-fast action who never hesitates. This belief has destroyed more accounts than any poor strategy because the market is designed to exploit impulsiveness. Every sudden candle or newsflash is bait for those who act before they think. Consistently profitable traders actually think more, but their cognitive complexity is different. An amateur sees a simple up or down question. A professional sees a system. If price rises on low liquidity, that means X. If volume drops at this level, the structure is failing. To an outsider, this looks like hesitation. In reality, they are questioning their own signals. While an amateur seeks confirmation, reasons to be right, a professional seeks disconfirmation, reasons why the signal might be wrong. They have the psychological strength to stand with the truth rather than their own desires. They don't overthink their potential profits. They overthink the conditions that would make their setup invalid. They spend less time clicking and more time sitting in trained patience, avoiding the mistakes others are making in real time. Part 3. The Tactical Retreat. This habit is perhaps the most controversial. At the peak of stress, they leave the screen. When the market is volatile, when the price is agonizingly close to a stop loss, or when a trade is deep in the red and every instinct is screaming for action, that is when the professional walks away. They aren't giving up. They are acknowledging biology. Under high stress, the amygdala triggers a fight-or-flight response, shunting blood away from the logical prefrontal cortex and into the muscles. This is great for outrunning a lion, but catastrophic for deciding whether to move a stop loss. The market intentionally creates scenarios that trigger this. The price hitting your stop then bouncing, or a trade you closed in fear suddenly running to your target. When you stare at the screen in a state of reaction, you begin to protect your ego rather than your capital. You'll add to losers or close winners too early because it feels reasonable in the moment. Standing up is a tactical reset. When you return after 15 minutes, the chart hasn't changed, but your mind has. In trading, your psychological state is more important than your technique. Part 4. Selective messiness. If you entered the workspace of a truly successful trader, you might see a mess, unwashed cups, scattered papers, or a dusty screen. But if you opened their trading journal or looked at their statistics, you would find a cold, clinical clarity. This is selective organization. Mental energy is a finite resource. Research on decision fatigue shows that the quality of our choices declines with every decision we make throughout the day. Professionals don't waste that energy on trivialities. They may be messy where it doesn't affect the bottom line, like their desk or their clothes, so they can be incredibly disciplined where it matters. Their risk management rules, their journal entries, and their morning analysis. Traders who try to be perfect in everything often make the worst decisions by 3 p.m. because they've exhausted their willpower quota on a clean desk. The messy trader has saved their mental capacity for the moment the real opportunity appears. Messiness isn't the problem. The inability to prioritize is. Part 5. Controlled obsession. Successful traders often cycle through periods of intense obsession. They might spend weeks staying up until 3 a.m. to backtest a single concept or master a specific type of price action. They disappear from social life to go deep. Then, suddenly they stop. They've understood enough and they move on. This looks like inconsistency, but it is actually dopamine-driven learning. The brain thrives on the feeling of almost understanding something. In trading, the market doesn't teach on a schedule. It teaches in random, painful bursts. To learn, you must be able to go deep. However, the professional also knows when to let go. Adding more information past a certain threshold actually reduces decision quality by creating unnecessary complexity. Amateurs either stay on the surface or drown in analysis paralysis. Professionals move flexibly between these states. They dive deep when necessary and step back once they reach the point of diminishing returns. Part 6. External silence, internal noise. Have you noticed that the best traders rarely talk about their predictions in public? They don't argue on forums or declare where Bitcoin is going next. This isn't just humility. It's protection against consistency bias. Once you announce a prediction to others, you create a social commitment. Your brain then feels the need to protect that commitment to avoid the social pain of being wrong. If you tell everyone, "I'm long on gold," a part of your brain now needs gold to go up, causing you to ignore signs that you are wrong. Consistently profitable traders stay silent externally to keep their minds objective. However, when they are alone, they are noisy. They argue with themselves, write exhaustive journals, and question every assumption. Silence on the outside protects them from social bias. The dialogue on the inside helps them process the truth. They avoid market chatter not because they are arrogant, but because they know that every social interaction consumes the mental energy they need for the charts. Conclusion. The power of the pause. All 6 of these habits share a common thread. They are not about technical analysis or entry systems. They are psychological buffers designed to protect the quality of your decisions from your own human instincts. In the financial markets, human instinct is almost always wrong. When the market flies, instinct says buy, FOMO, which is the moment of highest risk. When it crashes, instinct says sell, fear, which is often the moment of opportunity. Professionals don't become robots. They simply build habits that create a pause between emotion and action. Self-talk is a pause. Overthinking the right things is a pause. Leaving the screen is a pause. Staying silent externally is a pause. Consistent profits aren't born from perfect strategies, but from the ability to not act when instinct is screaming and to act only when logic has finished its check. Look at your own strange habits. Have you tried to get rid of them because someone said they were weaknesses? If so, you might have been discarding your best tools of protection. If you have no such habits, ask yourself, between the moment you feel like doing something and the moment you do it, what stands in between? If the answer is nothing, then you found your problem.